Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, Inc., New York's window company, Capital One Bank, Greenberg Traurig, LLP. Additional funding for this program is made possible by grants from AVR Realty Company, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, F.J. Siami Construction, Friedman LLP, Gemini Real Estate Advisors LLC, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackel Realty Services, M&T Bank, Marcus and Millichap Real Estate Investment Services, Meridian Capital Group, the Moynihan Group, Margolin Weiner and Evans, LLP, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling Inc., Stonehenge Partners, Urban American, the Witkoff Group.
Hello, my name is Michael Stoller. We're in the spring of 2010. Allegedly we're out of the recession. There's a little problem in Greece. There's a little other problems happening over there. And people think that the world of real estate is really getting better. So today I've assembled a distinguished group of former guests who are going to give their insight and their thoughts on the state of the market. My guests today include Steven Siegel, the chairman of global brokerage at C.B. Richard Ellis, Jonathan Mechanic, worldwide chairman of the real estate practice for the law firm of Freed, Frank, Harris, Shriver, and Jacobson. Coming in from New Jersey, took him a little while to get here today, our good friend Stephen J. Pizicki, chairman, Grand Poobah of SJP Properties, and last but not least, the newly appointed co-chairman of the board, associate broker, maybe? Okay. Our good friend Bruce Mosler, co-chairman of the board of Cushman and Wakefield. Stephen, you haven't been around here recently, and we were going to call this the Pizicki Report today.
Thank you.
So,
Thank you.
What's happening? I mean, I realize you got Governor Christie over there. They just raised the prices on the trains and the buses. What's happening in New Jersey? That's why you're in New York today, because you also have some great properties in New York. But what do you see happening in the market today in New Jersey and in general?
In New Jersey, if you got to look at a little history to talk about New Jersey today. And New Jersey lost Lucent and AT&T, enormous loss. And it's really taken a long time to fill that. The pharmaceuticals did to some extent, but we're still catching up from those losses. The waterfront has pretty good activity and is fairly tight. Suburbs are a little quiet. So that kind of sums up New Jersey.
Mr. Siegel, you remember when you were spending time in New Jersey?
I do indeed.
So has the world got any better 25 years later?
In New Jersey or for me?
And for you, I think.
He's in New York, it's easier.
You first.
No, for you? Boy, you really needed a lot of work up on this.
I wanted to. Your wife have a younger sister?
Oh, man.
Okay, come on, get back to the show.
It's interesting. The world in New Jersey, if you took it from 25 years ago to now, of course it got better. The density of office tenants, the expansion internally, just the growth overall. But Steve is absolutely right. The loss of Lucent and AT&T were tremendous blows. They were expanding constantly. You could always count on them every year for some type of growth and expansion. And that's a blow to the state. So it's, as he said, outside of the waterfront, it's been kind of flat for a number of years.
So that's the end of New Jersey today. Now we're going to talk about New York City, because there's nothing more to talk about in New Jersey, right, Steve? So let's talk about what's happening in New York.
You know, we've seen great activity for probably now a full year. You know, clearly prior to that it was, you know, in the bunkers, nervous to do anything. But we are seeing, you know, large blocks of space dwindle, particularly view space. And we think that will continue. You know, we'd like to see more absorption, tenant activity, but we do see it picking up.
So has the office market reached the bottom?
I believe it has.
Midtown, certainly.
The leasing velocity is tremendous. Rents have not felt the impact yet, but they will very shortly.
There's no question that with Midtown vacancy now roughly at about 13.8, that we've hit the bottom, we're at the trough. There's also no question that in the last couple of months, and I think Steve is right, it's really since November of last year we've seen a business pickup. But what's driving activity at the moment is that 45% adjustment in net rents. We've had 2 million feet leased in the last couple of months. That's back to the peak of 2007 and to some extent beyond. But you have to get underneath that and ask why. The reason why is the profound rent adjustment. There's a lot of folks with 2 and 3 year lease expirations that are in the market right now trying to take advantage of this moment in time. And for landlords that have strength, that have little debt, they're able to meet the current market. They're taking advantage of that and picking out the best tenant credits. This is a very good time in terms of demand, but it's demand based on rent adjustment, not based on employment and net absorption. That's what we have to look for this to be sustainable.
Although we're beginning to see some growth. Some
32,000
hiring again.
jobs added, right?
Yep. D. Shaw was full expansion. Morgan Stanley is
we are. That's a
hiring
good
again.
sign, but that's what's needed for sustainability,
I
Steve.
agree.
And the very good news is that we sort of, again, hit the trough in Manhattan in terms of employment loss at about 170,000, which was almost half of what they thought it might be. It could have been 300. It's 170, and we've added back 32,000 jobs. That's a very good sign. If we can maintain job growth through the rest of this year, I think we're going to be in
Can
good
we
shape.
ask the counselor over here,
Yes,
who
sir.
occupies a lot of space in Lower Manhattan, what's
Yes, he does.
happening in Lower Manhattan?
Well, I think that, I mean, there is activity. Not as much activity as there is Midtown, but Steve and I just worked, the deal just went public yesterday with Kenyon and Kenyon leasing 200,000 square feet at 1 Broadway. They basically occupy the whole of the building. I think that, you know, there's questions about the Trade Center, when the Trade Center's buildings are coming online. What does that mean for Lower
But I
Manhattan?
think here's a big thing. Without asking you what the final rent was, because that's not I'm not here to write that type of. Isn't there a major difference, cost differential, for somebody to go down to Lower Manhattan as opposed to going into some class good space in Midtown Manhattan?
One time there was a significant gap between A space and A space downtown and
That's
Midtown.
right.
That gap is narrow because of, as Bruce already said, the precipitous drop, if you will, in rents or net effective rents with the work letters being offered and the free rent. So for a Class A building called the Seven World Trade, 32 Old Slip, etc., the gaps are narrow at the World Financial Center, but they will be significant again.
Steve is right. Long term, we will see the rent gap widen again. Downtown has always relied on a very healthy Midtown, and Midtown rents being pushed up. Historically, there's been at least a $20 gap between the two, and that's what's driven downtown success. That's going to happen. But let's also remember, this was a Midtown recession. The businesses that were affected in this downturn over the last 24
The rest of the world
months.
wasn't.
No, just in terms of the rent, where this most impacted rent adjustment, it was more profoundly felt Midtown, given the tenant makeup.
I also think that the run-up had been much more dramatic.
No question.
Midtown. So when you were at the peaks Midtown, when it
That's
fell
right.
off, it was more like falling off. I don't
Agreed.
think downtown had
I
risen.
think
Well,
Bruce
at
is
one
right.
quarter, we had a 32% increase in average rents in Midtown.
Steve?
That's right.
And the amount of sublet space that came on in Midtown was pretty dramatic relative to
correct.
downtown.
But some of the landlords, it was almost like a run on the bank. They dropped their rents so quickly when I believe they really didn't have to. They could sustain. They dropped it because they were competing against sublet space. That they sustained it for a longer period of time, or a somewhat longer period of time. As rents moved back up, they would have made up for locking in long term at much lower rents.
You're right, Steve. The flip side is for a number of these landlords, particularly the REITs, that have gotten healthy very quickly. When the minute that the equities markets opened up, which is now about 9 months ago, 6 months ago, they've been able to raise significant funds, add to their war chest, lower their debt,
But
and
isn't
compete.
it true that the families, the well-established people like the owner, good
Yeah.
operator like Stephen, and
Oh,
the
yeah.
REITs, they're the guys who've been leasing space because people know that they're strong and they feel much more comfortable as opposed to the over-leveraged, guys in the market who are in special services now
There
or
are
something
three
like that.
buckets.
But I think
Sorry.
I think that it depends. It requires more structuring and more creativity on the part of the parties to the transaction and the lawyers in a circumstance where you have somebody who's got
1-800-FREE
issues.
Frank, is that?
No, I just think if you're in a low leverage building and you've got Vornado or Boston Properties or Brookfield as your landlord, there's just less of an issue in terms of thinking about what those concerns are. If you're in a building where there's a question about where the TI dollars are coming from, where the leasing commissions are coming from,
Yeah, which is
then
still
you
a significant part of the market.
Right,
at
and
the end of the day.
then you need to structure around that in order to make sure that those
Can I
things
ask
are
a
addressed.
question with regard to financing? Because I know Steve, because I ran into your banker at PNC, they recently said they did some financing with you, and you've been out on the market, and anyone and I know you do a lot of financing deals. Money is more available today, right?
Much more
question.
available. Much more
No
available.
question.
Not only that, lenders that have expiring loans or loans with a servicer are of the mindset not to take property back. Not all of them, but they're of the mindset to rework that debt, have it recapitalized, bring somebody in if they can. I went to a conference about 6 or 8 months ago, and somebody made a very profound statement. Be nice to your lender because they will be your lender. And they're right. I won't mention names, but we did a deal at the end of last year which closed for a building downtown. The servicer was involved, the primary lender was involved, and the mezz lender was involved. And they were very much behind getting that deal done. And so they made those qualms that John mentioned, they eliminated them. Getting paid,
but
the
Mike-
work being delivered, et cetera.
Three things have happened, I think, on the lending side, and some more recently than others. But the first is that, like the equities markets, the lenders have come back into play, and whether it's foreign institutions or whether it's the major money centers or other forms of financing, there is clearly more money available. There's even money available at higher loan to values than we originally thought. If somebody asked a year ago what we thought the LTVs would be on some of these projects, the loan to values, most of us would have sat back and said we would have been very happy with 60 to 65% LTVs. The truth is that with well-leased, decent credit properties, we're already pushing past that. So there's some very strong signs. Even just to give you a sense of the strength of the investment sales side of the marketplace, we've had properties that we put out to market last year where you had 0 bids. Today you're seeing multiple bids on these properties, all a sign of the fact that people believe that the market has come back, flight to quality, and recently certain assets that are about to sell that are showing 5 caps or 5+ caps. This is a very good sign for the future. For those quality assets.
I think the sale price of properties probably has almost doubled since a year ago.
I agree.
At least. I mean,
think that's
last
exactly
year
right.
your average building sold, if it was a good property with seller financing,
If
for
it sold.
$350 a foot. Now you have 340 Madison at $730. You had 600 Lex at $660 a square foot. I mean, this is high, and that's what I'm a little worried. The price has gone up too fast.
The prices really never fell that dramatically. If you look at the bad times, the better quality properties just didn't sell.
They just
There
didn't put them
was
on the
it
market.
was
Right.
probably
Very
one of the
little that was
slowest
selling.
periods for activity.
Exactly
The
right.
sales sides for all these firms were quiet as could
90%
be.
off the peaks.
And
It was
I
quiet.
think the answer
the
is
one
commercial
damaging.
property didn't fall as much as people thought. And what you're seeing in Lex, 600 Lex is this ground lease that sold for that kind of number.
Yeah,
Without any retail.
Yes.
With
So you're
truly
seeing-
no retail on
And
it.
there you have landlords. Their landlords were smart. I'm not putting my property in the market because I know the world will recover.
That's
and
right.
At the appropriate time, I will. And what these sales indicate is there are people out there that believe that rents will rise significantly.
Yeah, the one thing we ought to say is, Michael, that this is not going to be, in my opinion, a recovery that lifts all ships. The cliche that a rising tide lifts all ships, in this particular recovery, I think we're going to see a bifurcation in the market. There'll be 6 or 7 gateway cities in the United States. There'll be some core cities throughout Europe. The same in Asia. But when you start to look at the secondary and tertiary market, I think this is going to be a slower recovery for those marketplaces than we've seen historically in the past.
I agree.
I think you're even seeing what Steve said before about the New Jersey office market, with the exception
That's
of
exactly right.
Jersey City and Hoboken, is still slow. The Westchester market is miserable.
But that's the Jersey market is not from the decline that we had in the last couple of years. It's been slow for years.
Yes. It was slow leading into the
It was slow
recession.
before.
It was slow
You mean when
before
he
the
had black
downturn.
hair?
Yeah.
That's right.
Washington, for example, is booming right now. I mean, absolutely booming. Speculative buildings are leasing up. There's 2 tenants, 3 tenants sometimes competing for space.
Well, it was
Boston's the same right now.
the first market to see a real investment sales trade when DECA acquired a particular asset at a 6 cap rate. So it's Washington is probably, along with New York in the U.S., the most desirable investment markets from a foreign investment
So
perspective.
what do you see? What do you see going forward in the next 6 months? Do we, and let's talk about other asset classes. Any idea, especially since you are in the retail business in certain of your other vocations?
I mean, residential business.
Residential. It's, residential and
Well,
retail.
my wife's in the retail business. She
She
shops.
supports the retail business.
No. I forgot. What about your apartments?
Actually, we, thanks to the gentleman on my right, have renegotiated now 2 sets of our portfolio in the Bronx, very successfully recapitalized, and we're in pretty good shape. But we see multiples moving, albeit slowly, same as rents.
We tried to close that just before the show so that we
It was
would,
closed last night, actually, and it was a win-win for us. So we see our Bronx portfolio improving dramatically.
I think
rents
are still
one
down.
moment. Rents in New York City. No, we extended the debt, an additional 5 years over 212 expiration. The Manhattan market rents, according to O4 Yardeni, he's 101% leased. He has a
Ophir's
waiting
never
list.
not been 101% leased.
But he's still paying brokers and giving concessions.
That's right. Something that he never did.
Gotta love him.
Ofer was here a couple weeks ago. He's still paying. He's paying 1 month, brokerage commission. That's it. But here's the interesting thing. The reason that the residential is doing well is that you have a lot of multifamily lenders out there. I mean, there's a bank from New Jersey called Investors who was on my show a couple weeks ago. They opened up a loan production office in New York. Everybody wants to be in the multifamily residential financing. And Fannie and Freddie.
Well,
they're giving away.
I think you have a bifurcated market right now. You have clearly on the rental side in better locations, rents, concessions going down, rents are pretty staggering. It's hard to believe people can afford these kind of rental rates. The condo market has cooled a bit. I think the buyers, even though you're seeing jumbo mortgages come back for those buyers and the mortgage market softening up on the residential side, people are a little cautious on the buy side on condos.
Yeah, well, I think what's happened there
Again,
too
it's locationally
is-
driven, right?
yes,
If
yes.
Central Park West, if you're seeing the demand is still very strong, even resales, and that we're hitting peak
But the Upper
pricing.
East Side and Lower Manhattan,
Lower
on the condo
Manhattan,
side,
but
and downtown
to Steve's
Brooklyn
point,
is,
it's a bifurcated market.
Yes.
Yeah, but I think Tribeca's coming back. I
I
spoke
agree.
to Dolly Herman, I spoke to Pam Liebman, and they both said that their level of activity is the same. Pricing hasn't begun to move yet, but now all of a sudden, the same as it
Not
was 2 years
inconsistent with
ago.
what we're seeing on the commercial side,
Yeah.
excepting ours is more of a broader.
Yeah, so people
at this
aren't
point
jumping
recovery.
on stuff, and they're not closing as quickly as they used to, and they all think that maybe now's the time to take advantage. It's bottomed out, and they have a tremendous amount of people in the market. So I think you'll start to see it pick up dramatically.
It's ebbed and flowed at funny times. Last summer was very strong on the condo side. It was strong right through December, slowed down a little bit in the beginning of the year. We may have a decent, given the mortgage markets coming back on the jumbo side, we may have a decent summer again, which is an odd time to be selling a lot of condos.
Steve has a
Down and out.
terrific building on
The Platinum is
45th
right.
and 8th.
Platinum
called the
is,
Platinum.
loans are all paid off. We're down to a couple of units, and it was a very good project. Even bringing it through that tough time, it just shows there is a pretty strong demand for the condo market in that Midtown market. And
What's
Times Square
happening
market.
in the Jersey City Hoboken market, which many people consider the sixth borough to the city of New York?
Commercially,
Commercially.
we really haven't seen it. The amount of sublet space. Come on, when corporate America looked at their portfolios, they said, "Look, let's sublet, which we can get some big dollars off, back for." So that we didn't see big blocks of space come on the Jersey side of the waterfront. So you're sitting there with kind of an interesting market. You haven't had a lot of activity, but the amount of space and availabilities are pretty thin. I think I'd like to take your role for a second, Michael. I'd like to ask a question. I don't get to be with these fine gentlemen where you can get a word in.
I'd love you to take the role, but I don't know if I consider them gentlemen.
Well, they're gentlemen, they're brilliant, and so I think there is a concern in Midtown, and maybe we're not going to see it in the next 6 months, but clearly we could see it in the next 12 months. And that is, it's a great city. We want to attract global corporations. We're not going to see a lot of development of these great buildings that these companies need. The LEED certified buildings, the buildings that are efficient, the buildings that, the technology in the office buildings have evolved dramatically in the last 10 to 12 years. Destination dispatch elevators, floor to ceiling glass, concrete cores, platinum, and gold certified buildings. Air filtration is going to be an incredibly important thing for the corporate office user, and the young people understand this. So I think we're at a point where if you look at the decision matrix prepared by the biggest brokerage firms in Midtown right now, they're totally focused on price. They don't look at new versus old. They don't look at the type of improvements and amenities that are out there today and being incorporated in some of the new buildings. With the rental rates and the financing markets, because we still see, although the financing markets are back, we still see tight underwriting, which we probably needed for the past 3 or 4 years.
Agreed.
So coupled with that, I think you're seeing a lot of corporations, and Bruce said it, rents have come down for good product and, A, B, and C. Clearly C isn't going to come back as quick. B and A, we're starting to see the activity pick up. But with the average age of Midtown buildings, the average age being 60 to 70 years old, and corporations now looking at these decision matrix that are prepared by the brokerage companies and clearly instructed by corporate America, which has constraints on spending, which are I think there's some short-sightedness happening. I think these leases in Midtown are generally 15 to 20 years. Some can be longer. So you're making a decision for a firm that's influenced by this gap of let's get the cheapest deal we can. When it should be, let's take advantage of these rents, reposition the firm, put the firm in a position where they can attract great talent, where that talent can feel the benefits of all these improvements in technology that are occurring. And the sad part is we're not going to see a lot of new buildings built. So I think this is a time where the brokerage community should encourage the corporate community to not be short-sighted.
Can I jump in for a second?
Sure, absolutely.
Because I think what you've articulated is very, very well an accurate overview of the Midtown stock. From the advisory perspective, when Steve or myself are hired to advise a firm, I think you'd be surprised at how high up when it comes to environmental issues and being LEED or gold or platinum certified. That's very high up on the list. It happens to be expensive to do it, but it also can be done in an existing or an older stock building. We did it in not an older stock building, but we did it in our headquarters at 1290. We're gold certified, and it is an economic issue. You're absolutely right. But people are cognizant of the fact that to attract talent, future talent, to sustain your firm's success, you got to be thinking about the future in terms of creating a more collaborative, interactive environment. at the end of the day, but let's remember that corporate America over the last 18 months has gone through the kind of right sizing, and for survival reasons has had to see their profits sustained only through cost-cutting measures. So there's no question that corporate America has been digging out for the last 18 months, and for the first time, I think we're beginning to feel better. Revenue growth is there again, but profits today are still being generated by watching your bottom line. So it's the balance, and I think that's what we try to strike in advising clients is thinking long-term with remembering that the economics are still important.
We do actually sell exactly what Bruce and Steve are talking about. We truly believe that in the next, if it's not this generation, and Steve and I have discussed this, it'll be the generation after that, that they will not want to work in a non-LEED certified, fresh air quality building. My daughter, when she was filling out her college application, they asked for 5 words to describe herself, and one of those was green. Even her generation may come out and say, well, you know, I'm given 3 choices, and one of them is a LEED certified or platinum building, gold or whatever. That's where I'm going. And I tell this to law firms, I tell this to other tenants that we're representing, that you ought to think about that, as Steve said, not make a short-term, narrow decision.
The irony is, the Googles of the world are at 111 8th Avenue. That's not a green certified building. A lot of people are at Chelsea Market. They're not green certified
Their
building.
space may be LEED certified.
But you can certify your space. You can make your space
And remember,
green.
as I just said, we got a gold certified space by virtue of how we designed and the architecture of our space.
You got the grass outside, I remember.
So that's right. It's very important for us
bamboo.
And Michael, I would say, because we just signed our lease in D.C. within the last 6 months, and that was one of the factors that we considered in deciding where we're going to go.
It's very important to them.
Looked
So
at
it's up
a number
on
of
the,
different
it's high
buildings.
up on the list of most tenants.
And ultimately, the pricing, because of what the timing was in the market, coupled with the kind of building that we moved into, which was the Dreyfus building on K Street, and it was platinum certified, and people were very excited about it. And so we weighed those things and ultimately decided that balance, which is exactly what Steve said people should be doing today, made sense for us to do. I think we came to the right decision.
There are a few firms, though, that are long-term focused right now with the pressures like Bruce talked about.
I think what you're saying,
to bring profits
there
to the
are
bottom
very
line.
few firms.
There are very few firms. I mean,
But I think
John's
they're
firm
gonna
would
increase.
be in that position.
It's
Some of
going
the
to
law
increase.
firms that know that at the tough time, attracting talent, retaining talent.
I think you're right about that.
Being on mass transit hubs, being in green buildings, it's very difficult to focus on that now. My concern is that if you look at the spreadsheet analysis that's prepared by all the major brokerage firms,
I wish we had more time.
Show should be much longer.
But I have to say goodbye, and I'd like to thank Steve Siegel, Jonathan Mechanic, Steve Pizicki, and Bruce Mosler. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, Inc., New York's Window Company, Capital One Bank, Greenberg Traurig, LLP. Additional funding for this program is made possible by grants from AVR Realty Company, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, F.J. Siami Construction, Friedman LLP, Gemini Real Estate Advisors LLC, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, M&T Bank, Marcus and Millichap Real Estate Investment Services, Meridian Capital Group, The Moynihan Group, Margolin Weiner and Evans, LLP, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling Inc., Stonehenge Partners, Urban American, the Wickoff Group.